Bensignor, and welcome to this week's In the Know Trader Show. Looks like U.S. equity markets continue to be near the highs of the year, and in the case of the S&P, it's less than 2% from all-time highs. So look, before we delve into looking at some charts this week, I want to talk about the issues that come up and the situational event of when the market is continually telling you that what you're thinking and the thesis you've got is possibly wrong. And after we do that, we'll take a look at some charts. So I want to start with this chart. And I've purposely covered both dates and what the security is in order to just talk about the way a technician would look at a chart and evaluate what's going on, but also with a sense of understanding when is your thesis wrong? What does the market need to show you to make you think that what you thought was going to happen in the future and the positions that you put on because of that may not be right? So we start off here with something that's clearly in a bear market. It broke underneath the horizontal teal-colored line quite some time ago. This is a daily chart, by the way. So, it was months and months ago. There's a long-term downtrend line in dark purple, which did get broken above, but the long-term downtrend is down. And then towards towards the bottom right-hand corner in here, these lows in here were just beneath the lows here. So you still kind of you made a lower low, but then you popped right up. And you can see I've got three horizontal orange-colored lines that all represent resistance. And you can see as of when this chart is showing, it's bounced off of, or let's better said, the rally got back up to the lower of the orange lines, so it's facing resistance. And you think that this is range-bound, but generally in a long-term decline. I'm going to add a little extra data here now, and it looks like we're breaking out to the upside. So most technicians would put this into the camp of, short-term breakout. Certainly there's overhead resistance well higher, but there's at least some type of short-term breakout to the upside. And then we're going to bring it a little more. And then here's where I think you have to start questioning if this breakout that, let's say, you could have easily played and gotten long at what now appears to be a very dicey situation, is this the right thing or not? And let's say if it broke underneath this lower of the three trend lines again, would it suggest that the breakout was in fact a false breakout, a very quick one, and the kind of general downtrend, or at least sideways prior move, is back in play? So the question really asking you is, at what point here do you reassess and reevaluate what was at the time apparently a breakout that then very quickly starts turning around? And if I bring in some more data here, again, you can see that this has certainly moved right back into the middle of the range. And if I bring a little more data in again, you're basically very close to the lows that were made in the past. So if I put this now and switch this from a daily chart to a weekly chart and show it to you in these terms, you can see the long-term downtrend line, the false breakout, and the move back down towards the lows. If I switch this to, I actually had this inverted. So the proper way of really looking at this chart was like this. And if I now blow this up so that you start seeing what it is, it's actually the S&P 500, and this just happens to be the Vanguard ETF of the S&P 500. And I purposely chose it just so it wouldn't be obvious initially when you're looking at it what it was. So if we go back and kind of look at what happened when February's low got broken last December, seems like every technician, or virtually every technician, got bearish and has been fighting this for almost the entire move up. And I just did a 1-hour presentation at this year's CMT Symposium a week ago talking about this is just one of the things that people got wrong, and then their unwillingness to change their mind, that this was simply part of, it was a short-term breakdown. But if we look longer term, or actually here, why don't I just make this the actual S&P 500? Go back to the 2009 lows. Let's just put a trend line up here too. The trend stayed, the long-term trend stayed, even if I take the 2011 low. Nothing broke on this move other than the 2018 price pattern of where we had seen prior lows break. And because, in my view, so many people are looking to be the hero, to call the top to the move, to call the end of the stock market's long 10-year plus rally, is why so many people refused to listen to what the market was saying. And I think this is one of the most important things, is whether you're a technician, whether you're fundamental, or however you analyze the market, is to listen to what the market's telling you. It knows far more than you do. And one of the things that you pick up as you spend more time trading markets is to actually pay attention to things that look like breakdowns or breakouts, only to see them completely turn around. So if you think about it, this move heading into Christmas created the lowest close. So it's a 1-week violation. The next week came strongly back. The next Friday closed on the high. The next Friday closed on the high of the week, back above. How can you still, the next Friday closed basically on the high of the week. The next Friday got, I mean, look at how many Friday closes are virtually the high of the week. How much does it take in order to stop fighting the concept and the idea that at the time, at least possibly felt right, that this was breaking down? So if we switch this back now to a daily chart and we add, here, let's do something that most people did. So we'll get rid of our trend lines. And let's do a Fibonacci retracement. So we go from the all-time highs to the Christmas low. So people were selling against the 38% retracement, saying, it's just a dead cat bounce. And the 38% retracement was beneath those two lows earlier in the year. Oh, actually, that's October. Sorry. Let's take this back. So the 38% retracement was just about where the lows were. That was theoretically a good place to be a seller, an intuitive place to be a seller, if you thought this was a real breakdown. But then it continues moving higher. And it pushes through the 50% retracement. And it pushes through the 62% retracement. And it pushed through the 50-day moving average. And it pushed through the 200-day moving average. And yet I would still, there's the 200-day in green. And yet I would still see people in the media, reports coming on the street, technician after technician saying, bear market bounce. And if you've heard my podcast before, you know that we never turn bearish, even in December. By January 10th, we were in print in the No Trader clients, telling them that the Christmas low was not just a good trading low, but the low for all global equity markets. and that what had been a bear market throughout most of 2018 for the rest of the world, but not in the US, actually, and then the US sell-off in the fourth quarter, especially in December, was not the beginning of a bear market. It was simply a quick technical sell-off that turned immediately around. And you can see as of right now, we are just, 20, 30 points away from all-time highs. And yet all the way up, people sold against it, fought it, wouldn't listen to what the market said. And I got to tell you that once we broke back above the 38% retracement level, which essentially got you back above this low, and let's say here, so the three higher lows that we saw in early 2018, how do you still make the case that it's a bear market? If you're listening to what the market told you, you'd have a really difficult time. So even if you shorted, let's say you didn't sell the December breakdown, but you shorted the bounce, the 38% retracement, and you could have easily done that. It wouldn't have taken much more than 50 to 75 S&P points to know you were wrong. 2 to 3% should have been your max loss on this. And yet, as of just even 2 weeks ago, I see a well-known technician who's on CNBC all the time, still fighting the idea and saying, bear market. And I simply can't understand how an experienced technician could do that if you simply listen to what the market's telling you. So one of the valuable lessons that I've had in my 35 plus year career on the street is listening to what the market tells me, in the sense that if you've got a trade on and it could be working your way, or let's say it's not working your way, there's a point at which you have to respect that what you thought was going to happen simply is not. And it doesn't matter why, and it doesn't matter a lot of other things that you'll hear and read in the newspaper, in other forms of media, on television. One of the things I heard recently is that, and here, let's see if, no, it's not going to put up. I was just hoping to get, it's because it's the cash. Let's try spiders. So here's volume. And what I'm hearing is this is a low volume rally, so it's not important. Well, the volume that we've seen since Christmas, when you got the spike, right, is kind of pretty steady, and certainly lower than the big declines we saw from the highs, but in line, if not slightly higher than what we saw for much of last year. So if you take away the periods of volatility, which obviously would increase volume, this move is similar to what we've seen in the past. So I can't say this is low volume. It's only low volume to what we saw in December, or the couple of spikes up in volatility. If I turn this into a weekly chart, and we go back to, this is also something that I find almost amusing. There are technicians who missed the entire rally after the 2009 lows were made because they said that it was low volume. Well, yeah, it's low volume relative to the increased volatility period we saw in 2007, 2008, and 2009. If you're going to use volume as your criteria, you've got to look at it historically and not just at the times that volatility is high. So if you look at how much spiders have traded in the last 5-6 years relative to what they traded previously, it's significantly higher. Don't simply look at the periods of high volatility to compare against. It's not the intuitive way of looking at volume. Plus, we've got to realize there's another big factor here, and that's how much computers factor into how much trading gets done these days and how much is done through computers versus the public. And because it's around 3/4 being done by computers, it would be a big surprise if volume was lower than it has been in the past. It's computers trading. They're not humans with emotional biases the same way. They're just doing what a programmer programmed them to do. So be careful when you look at volume for being confirmation or non-confirmation, especially if it's low volume. I've never been a fan of thinking that low volume means something isn't really happening. Look at the move off of the Christmas low until where we are right now. Yeah, so volume's been kind of steady, but obviously lower than the spike up come Christmas time. Is this 500-point rally in the S&P not a real rally? I'd say it's as real as it gets, and if anything, it suggests higher prices. I mean, we certainly could stall a little bit near all-time highs, but we've already pushed through these highs, which were the early part of 2018. And, you know, it's hard to think that we're really going to make any material pause here against the all-time highs. This would tell me, in fact, the fact that the lows were the 200-week moving average, that's all positively sloped, and also caught the lows here at the early part of 2016 when we had the big sell-off. Nothing has really changed in my mind that we are in a long-term bull market, and that this decline here, which really was a 1-week decline when you think about the break, was one Friday close that was a down Friday close beneath these other lows, and then everything else has basically been straight up. That says to me long-term bull market still in play. No trend lines of significance were violated on a long-term basis. Only some horizontal levels were in the late fourth quarter of 2018, and this should continue well higher over time. Nothing's changed, and yet way too many technicians have been fighting this and thinking that we're in a bear market, or we were in a bear market. Bear markets don't exist for 1 or 2 weeks. I'm sorry, that's not. Don't listen to the media or somebody saying, "Hey, the S&P fell 20%, the Nasdaq sold off 23% from its highs." Those are bear markets. Those are artificial numbers. They don't mean anything. A 20% move doesn't qualify a bear market. It's people trying to put labels onto something in order to make reason out of market movement. And there's a valuable lesson in there too, because the media and the newspapers, you know, need to sell ad space, and they need to do anything they can to get people interested. And typically the loudest barkers of a bear market are on TV just about the time the market's bottoming. So that's my take, and kind of just a tip for this week is listen to what the market's telling you. And if what your thesis was isn't playing out, then just get out, take the loss, and reevaluate. But sticking with something that's not working is silly, and generally will just cost you a fair amount of money over time because of stubbornness or unwillingness to be wrong. And just say, you know, my thesis didn't play out. The smartest, most successful money managers are those who understand that, who readily take losses as part of the game and don't fight the whole idea. And you know, they're not trying to be perfect. Think about sports. Think about shooting in the NBA. If you shoot, you know, what percentages are considered high shooting percentages? Think about a Major League Baseball player who, if he gets on base 3 out of 10 times, is one of the best in the leagues. I mean, 7 out of 10 times the person is failing. You have to think about that in terms of the market too. And you have to get used to failing frequently. The goal, though, is to keep the losses small. Recognize then when what you thought was going to happen is not happening, and listen to what the market's telling you and get out. And if you can keep your losses small, but when you're right, ride your winners, as long as the market is proving out your thesis, then stay with the winners. And that's those thoughts. We've got about 10 minutes left or so, so I want to take a look at some of the stocks that are going to be reporting earnings very shortly. And with technology being the best performing sector of 2019 by far and away, the best performing sector, let's take a look at some of the big weights and the FANG names. So I'm going to start off. I actually changed FANG, my terminology, to be MAFANG. And MAFANG includes, well, here, we'll go through them. We're going to start off with Microsoft. These are weekly charts, so we kind of get a bigger picture. There is theoretically some minor resistance to just shy of 122 with an upside propulsion target about 123.5. Only if you happen to be bearish going into earnings can you use those as reference points, but any moves through those don't right now have anything that I'm seeing of significance well higher. So this is on all-time, or well, this week we've made all-time highs. Again, we're going into earnings season here. The sell-off in December came right down to the weekly cloud. And you'll notice the last time we got down to the weekly cloud, which was back in 2016, that was the bottom then too. The top of the weekly cloud was the bottom this time. Nothing's changed, long-term bull market, and I suspect this goes higher. Now, if earnings disappoint and the market, the stock comes in, where are the places to look at should you want to get long on a pullback? And barring Microsoft completely falling apart, which I don't think it would likely do, the levels I'd look at right now are about 116, 114, and 110.5. These three levels, or any, you can choose one and put all your money in at one point. You could spread out and put some in it at 116, some more at 114, and some more at 110 or so. That's the way I would play this on a pullback. So I think there's still room to go on the upside. Let's take a look at Apple. Here's a weekly chart of Apple. Notice the setup 9 count on the bottom for those of you who have listened to my prior shows and webcasts and know Tom DeMark's sequential model. It's one of our key models in being able to identify exhaustion of trend. Both the cloud model and the sequential 9 count at the time in December suggested that that's a likely turning point. And of course, once the market turned higher, Apple did too. And it has continuously moved higher. It is also through its 62% retracement. Just from the amount of time, let's do here a rectangle. If we just look at the amount of time, the amount of weeks that were spent up trading north of, let's say, 210 or so in this area, we know that there are, in theory, some trap buyers up here. Now, some would have probably sold out during the decline, but in theory, there's still a lot of people who still have exposure here and might very well be willing to reduce that exposure anything towards where they got long, having perhaps sat through the entire decline. And there's the I often talk about people finding religion when trades don't go against them. They kind of go into the, dear God, if you just get me back even, I promise I'll get out of the trade. So don't be surprised if you see resistance north of 210. But again, earnings are coming out. Generally, they've done decently on earnings as of recent. I suspect Apple will spend some time up north of 210. It will not just simply plow to new highs because of the, 10 weeks or so of trading activity there. But so it will deal with resistance. And if you've bought anything in Apple since the decline, and you're not concerned about the tax situation of a short-term gain, so let's say maybe you bought some in an IRA where you're not concerned about taxes with buying and selling, you may very well want to lighten up somewhere, between 210 and 225. And if you need to, you give up $10 on the upside for the chance that this could pull back $10 to $20 on the downside just because of the amount of resistance that's here. So this is a combination of understanding that there are some trap buyers up here. Pay attention, obviously, to what the S&P is doing itself. Again, I'm still generally friendly to the S&P and think it'll move higher over time. And if Apple comes out before we even get up here and let's say misses and you get a price decline, I'd say probably something in the mid to low 180s is a place that I'd be a willing buyer. Next, let's go to Facebook and kind of get to the F part of FANG. And you can see here too, sell off like everything else. It's recovered. It's not near its highs. You had this massive down week that was in July. So this looks a little different than some of the other charts. There is some cloud resistance right here. If I'm long this name and let's say you knew how to use options, you might sell some upside calls here as some protection in case you get a negative earnings report because you are up against some resistance because of the cloud. The cloud models conversion line, which is this magenta colored line, has caught the lows here and then recently a few weeks ago. So possibly some mild support near 170-ish. Much better support down here near 152, but that of course would be a plunking in the stock. I personally am out of this name just because I've lost interest in owning a company that I question all the privacy issues and stuff like that, and I could be completely wrong because I got out more for just my beliefs about the company rather than just the stock performance. So I made some good money on this, but I'm done. But again, there is some resistance in here going into earnings season. Let's take a look at Amazon. Here you go. Amazon, December, perfect cloud bottom. This time the bottom of the cloud. And it has also made a substantial recovery since, not far from, it's what do we got here? About $200 from all-time highs. We're on a weekly 8 count. There is some resistance, not a ton, but again, there's this area in here where you spent, several weeks. So there are some, again, in theory, trap buyers there. So anywhere from current price up till its all-time highs north of 2,000 does have some theoretical resistance. Next week's going to make a setup 9 count. As long as we close, as long as next Friday, not this Friday, but next Friday closes above 1798, you'll have a 9 count, possible short-term inflection point. And again, with some of the resistance here, if I was long Amazon, and actually I am in my own account, I'd probably lighten up in here, playing for maybe 200-point pullback or something like that. But tough name. I still want to have some exposure here in the name. I may lighten up, but given how this bottomed and where it bottomed, again, no long-term damage was done. The cloud model is suggested the low, and so that covers most of the FANG names. Thank you for tuning in. I'm Rick Bensignor, and this is In the Know Trader.